Hello everyone. Let's look at an interesting economic puzzle. So you must have read in the newspapers that net FDI in India is significantly declining. In fact, net FDI in India has reduced from $44 billion in 2021 to less than $1 billion in 24-25. On the other hand, in 24-25, you had gross FDI which was as high as $95 billion. So these two set of statistics together make no sense, because on one hand you have net FDI less than $1 billion, on the other hand you have gross FDI which was as high as $95 billion. So together these would make one question as to whether foreign investors are still interested in India's growth story, or do foreign investors have a confidence or a sense of confidence to invest in India in the long term. So what we're going to do today is that in today's video we're going to understand what these numbers actually mean. So before we get started, let's understand the key difference between gross FDI and net FDI. So if you talk about gross FDI at a basic level refers to the total amount of fresh investments coming into a country in a particular year. So let's say in a particular year you had foreign investors bringing in $100 worth of investments. However, you could have some of the foreign investors who had earlier invested in the country selling their stake and taking that capital which they had invested back to the country. So let's say you had $60 worth of capital which was taken out by foreign investors, which they had invested and taken back to their country. So the net foreign direct investment into the country would be the difference between 100 and 60, that is $40. So clearly from these numbers itself you can see that net FDI can be low despite a very high gross foreign direct investment. So a net decline in foreign direct investment does not simply mean that foreign investors are not interested in investing in a particular country or not interested in investing in India. However, having said that, it's important to understand why net FDI is actually falling so sharply. So broadly, there are two key drivers for a decline of net foreign direct investment. So let's look at the first set of reasons. So the first set of reason is that foreign direct investment as a category is not uniform, which we think of it to be. So there are three types of foreign direct investments broadly. So the first type is what we can call the real type of foreign direct investment, or the type of foreign direct investment we traditionally mean when we refer to foreign direct investment. That is, you have investment by multinational companies such as Toyota or Samsung, where these companies establish factories in the country, bring in technology, generate employment, and they stay invested in the long term because they want to help manufacture products and sell those products both within and outside the country. So these are the real foreign direct investments. The second type of foreign direct investments are investments by investors or financial investors. So this includes investment by entities such as private equity funds, venture capital funds, and sovereign wealth funds. However, the business model of these type of financial investors is different from the real type of foreign direct investments, because the key incentive or the key motive out here is to invest in a company, help that company grow and generate profit. And once that company has generated profit, what these investors do is that they disinvest their stake and repatriate the capital or send back the money they have invested back or outside of India. So that is the second type of foreign direct investment. The third type of foreign direct investment is investment by diaspora investors and special purpose vehicles. So this refers to foreign direct investment by overseas Indians into India. So if you look at the overall composition of foreign direct investment from 22-23 all the way up till December of 26, you will see that 42% of foreign direct investment into India was in the nature of real foreign direct investment. However, 40% or a significant sum of foreign direct investment was made by these financial type of investors whose main motive, as we've just talked about, is to earn a profit and disinvest and send that capital back to their country. And it is this type of foreign direct investment which is the key reason for a decline in net FDI, because these investors are now withdrawing the money they have invested by selling their stakes and transferring that money back to the country. So that is the first set of reason why net FDI in India is actually declining. The second major reason why net FDI in India is declining is because you have a lot of outward foreign direct investment which is being done by Indian companies. So you have a lot of Indian companies now which are looking at investment opportunities abroad and moving funds abroad. So outward investment or outward foreign direct investment by Indian companies is the second key reason why you have a decline in net FDI. In addition to these two reasons, there are other ways through which you can have a foreign exchange outflow out of India. For example, you can have foreign companies transferring the profits they have earned in India back to their parent companies. Similarly, you have dividend transfers by Indian subsidiaries to investors outside of India. On the other hand, the third type is you have Indian companies paying money for using foreign technology as well as using foreign patents as well as foreign brands. So these are the three key reasons in addition to the ones we mentioned right now which can lead to a foreign exchange outflow from India. However, if you talk about in context of this video or in context of recent developments, the reason why net FDI has declined in India is because of higher disinvestment and capital repatriation by financial investors, and secondly because of outward FDI by Indian companies. So looking at all of this together, one might wonder that while the decline in net FDI does not mean that foreign investors have lost interest in India as an investment destination, there are still two concerns which need to be watched out for. The first key concern is that manufacturing FDI in India actually remains weak. So in the years we're talking about between 2021 to 24-25, only 10% of effective FDI has gone into manufacturing, and this is worrisome because manufacturing FDI is key when it comes to transfer of technology, generation of employment, as well as improving the productivity and growth potential or export potential of the economy. So that's the first concern which needs to be watched out for. So there is a need to ensure high quality manufacturing FDI into the country. The second concern is that the global competition for FDI is increasing now. What is happening earlier post 2008 financial crisis was that the interest rates in the developed countries were almost zero. So thereby you had a lot of investors in these countries who were looking for investment opportunities in emerging economies such as India, and this was leading to an increased inflow of foreign direct investment into India. But today the situation is different because the interests have risen in these countries. For example, US 30-year treasury bonds are giving an interest rate which is more than 5%. Similarly, the UK bond yields have also risen over 5%. Similarly, Japan, which had rates which were near to zero, has also started raising the rates. So this clearly shows that there is more competition for scarce investable capital, or the global financial environment has become more competitive. So while you might think that foreign direct investment is different from foreign portfolio investment, because foreign direct investment is not only driven by interest rate and it depends on multiple factors such as what is the market size where the investment is happening, or what is the quality of infrastructure where the investment needs to happen, or what is the availability of skilled labor. But a rise in interest rate means that the cost of financing for investors has increased, and thereby investments are no longer going to automatically come into India. So to conclude, what you can understand is that while a decline in net FDI does not clearly mean that foreign investors are losing interest in India, because statistics clearly show that you had FDI, gross FDI as high as $95 billion in 24-25, and the reason why net FDI declined was because of disinvestment, capital repatriation and outward FDI. However, there are two things which need to be watched out if India needs to sustain its growth momentum. That is, while India attracts FDI, India needs to focus on attracting high quality manufacturing FDI, because as we talked about right now, it's the key to creating jobs and ensuring adequate or high quality technology transfer, as well as strengthening our export potential. Similarly, because now the environment or the financial environment has become more competitive, on the policy front, it's important to ensure that the ease of doing business improves. There is high quality infrastructure as well as policy implementation as well as availability of skilled workforce, so as to ensure that the scarce foreign capital moves towards India. So this was the broad understanding in context of net FDI. I hope you liked this video. If you did, follow the channel for more such concepts in regards to UPSC economics. Thank you so much for watching.